Welcome back to Organized, the business law breakdown on mastering LLCs. I'm Professor Seth C. Oranburg, and last time we introduced the power of LLCs and explained why many founders choose these limited liability companies over traditional corporations. In episode 2, this episode, we're going to zero in on the steps to form one. Assuming that you've chosen this is the right entity choice, we're going to go over filing the simple certificate to drafting a robust operating agreement, and we'll dive deeper in some of these topics later. We'll look at key provisions from the Uniform Limited Liability Company Act, like Section 201 for filing basics, and Section 105 for operating agreement parameters, and we'll address how capital contributions differ radically from issuing corporate stock. By the end, you'll see how the straightforward process can unfold, but also why skipping details can lead to major headaches. Let's begin with a quick scenario. Two friends are eager to start a custom furniture business. They're going to build furniture on demand, and they decide to form an LLC because they want limited liability protection from personal debts, from lawsuits. They also want pass-through taxation. Why pay corporate double tax when you don't have to? And they know they need to file the right paperwork. They have to deposit funds in a bank account somewhere. They have to define roles, but they're not exactly sure how. So they call you and they ask for some help. If they skip formalities, you tell them, they risk not only disputes with each other around who owns what, but also, if they skip formalities, don't actually get limited liability protection. That's where careful adherence to statutory steps really pays off. And while forming an LLC is often simpler than incorporating, the stakes remain high. And as I mentioned, this is a very customized form, so we need to be prepared to customize the operating agreement in a way that fits our founders' needs. Overlooking something as small as listing a registered agent or clarifying capital contributions can cause big legal trouble later. As I mentioned, they can lose the legal liability shield, or they can face tax confusion. Partners can be really upset when they receive a bill for taxes and they don't have cash to pay it. So we want to address these things ahead of time. First stop. ULLCA Section 201 explains how to form an LLC in states that adopted the Uniform Act or something close to it. Basically, in every state, you would file a certificate of organization, sometimes called the Articles of Organization, but it's the same thing. You file it with the Secretary of State, Department of Corporations. Tends to be more minimal than a corporate charter and typically has the following requirements at minimum. First, a name. Under ULLCA Section 112, the LLC's name must include something that designates it as a limited liability company. That could be LLC, limited liability company, or a recognized abbreviation. I have one called BizLaw LLC, and the reason that you require this is you want to signal to the market that they're dealing with a limited liability company. If you enter into a contract with BizLaw instead of with Seth Oranburg, you should know that Seth Oranburg is not liable for the debts of that particular business. That's what the LLC means. So we have to distinguish it from other entity types so people know what they're dealing with. Second, you need a registered agent. And that's a person who will receive service of process and must be in the state in which they are incorporated. Now, you can hire someone to do this. You have to pay them an annual fee. There are all kinds of companies that will serve as your registered agent. But there has to be a human being who will accept a summons or other legal documents. Otherwise, you can't legitimately be an entity in that state. And third, you have to have an effective filing. Once your certificate is accepted by the state, you officially become an LLC. You need at least one member and a few other requirements, and that's when the legal liability shield kicks in. If you didn't sign up any actual members, you have a phantom entity with no legal effect. And if the filing gets bounced because you didn't pay a fee, you have a phantom entity with no legal effect. By the way, the same concepts that apply to defective incorporation, we studied those in the incorporation series, those apply here too. Just to contrast this with corporations, which are older have concepts built into them, especially in Delaware, that have concepts that are in some ways out of date, like you have to specify authorized stock and par value and other complexities. LLCs let you skip a lot of those complexities. So for a small business, it really is simpler to get them started. They're particularly useful for single member corporations or businesses because instead of having par value and authorized stock and stock certificates and uncertificated shares, yada, yada, you just have one owner and they have 100% of the interests, and it's really simple. Now let's talk about the operating agreement. That's the real engine behind an LLC governance. Look, if you have one person, you don't need to have a contract that defines all these things. You still want an operating agreement that defines some things, but really the operating agreement addresses how managers are responsible to members and the rights and responsibilities of members to each other and the corporation. So if you don't have more than one person, it's really like a very simple short form. But if you have two or more persons, you need to have an agreement that is functioning like a partnership agreement, and that's what we call the operating agreement. Again, LLC section 105A says that the operating agreement is the main document for the rights and responsibilities. You could think of it as a constitutional charter, a private constitution that governs the management structure, profit splits, and decision-making processes. It can limit or extend fiduciary duties within certain limits, and more. While as a technical matter, you could have a totally oral operating agreement, this is a terrible idea. The Act does allow any form of agreement, but a handshake or vague email is a classic recipe for disputes. In the case In re Dixie Logistics, members ended up in court because part of their agreement was purely verbal. The judge had to piece everything together from contradictory emails and partial recollections, and at the end of the day, you have a fact finder deciding what the organization really intended when it intended to form. This is a mess. Steer clear of this sort of trouble by documenting everything in an operating agreement. Operating agreements usually specify how they can be changed, and typically they need to be changed in writing. They may require unanimous member consent, or a simple majority, or just manager sign-off. It really depends on how the organization is intended to be run. So this is huge for businesses that want flexibility as they grow. In corporations, amending bylaws and charters can be very cumbersome. And there's a lot of requirements, especially in Delaware law, about changing these balances of power between shareholder rights and managers. LLCs can sort of prescribe in advance whether it's easy or hard to change the operating agreement. And if you plan to grow fast or change quickly, you might want to make it easy. When drafting an operating agreement, the lawyer should think about everyday scenarios. How do you handle new members? Or if a member wants to sell their shares? What if there's a tie between what the members want to do? How do you handle distributions, especially when taxes erode? The more of these things you define, the fewer arguments you'll have down the road. One of those definitions involves capital contributions. Members typically promise to provide money, property, or services to the LLC. And unlike stock issuances, which are heavily regulated by concepts like par value and authorized shares, LLCs can simply specify each member's initial contribution in a simple capital contribution schedule or table at the end of an operating agreement. And one thing that's interesting about LLCs, which doesn't come up as often in corporations, is you can also have a concept of ongoing capital contribution requirements or capital calls, like a partnership. So if the company needs money, you might be able to go and demand that the partners or the members contribute more. We can do this flexibly. So again, the operating agreement, you'll hear this theme a lot, is very flexible. So one member could contribute, let's say, $50,000 in cash, while another donates, let's say, a patent. The LLC can weigh these differently and give $50,000 equivalent to 25%, or call it 50-50 ownership, or set some creative formula where the value of the shares changes over time based on the utility of the patent. I mean, the sky's the limit. Of course, the more complicated things get, the more people disagree, the more documentation is required, the more the lawyers get paid. So I'm not advising that you build in unnecessary flexibility, but I'm pointing out that the way that we structure the capital contributions is very flexible and particularly well suited when you have people contributing different sorts of stuff. If a member doesn't actually give the money they promised, the operating agreement can define penalties. And again, the operating agreement can require additional capital contributions over time, and a failure to do that can also have penalties. Those could be reduced ownership percentage, or personal liability for the shortfall, or even kicking out that member entirely. But again, without explicit clauses, you might be stuck in litigation or rely on statutory defaults, which are less precise. So as we're seeing, the operating agreement is going to have a lot of terms in it. And one of the exercises we do in class is to review one, right? They're much longer than corporate bylaws because we have to figure all this stuff out. The next thing we have to figure out is profit and loss allocation. The operating agreement can tie shares of profit and loss to contributions or some other approach. Maybe a person is contributing their time, and over time, they earn a higher share of profits. That's something we can do. We can create a formula. It's like a partnership environment where members might anticipate capital accounts that track each person's equity. But again, we don't need that. We don't have a fixed formula. We can borrow from either corporate or partnership strategies or invent our own way to allocate who is entitled to profits and who is entitled to losses. And by the way, I say entitled to losses because those losses flow through on the K-1 and you can report them, offsetting your individual ordinary income. But remember, the IRS can scrutinize these things. If it smells funny, the IRS could say, those are unusual allocations and can contest them. So you might speak with a tax advisor when drafting anything that's non-standard. This is a huge difference from corporate stock. In a corporation, shares must be issued under certain specific rules, again, specifying par value, authorized shares, disclaimers, or different clauses. The LLC approach is simpler, and we don't even need certificates for these shares. We just need to record membership interests. Before we wrap up, I just want to point out a major hazard that I mentioned before: oral or implied operating agreements. Yes, again, the Uniform Limited Liability Company Act allows oral operating agreements. They are a bad idea. Companies face contradictory testimony. Members will claim, he said we'll do 50-50. He told me I was in charge of finances. He said that I could earn more if I contributed more. He said, she said. Costly litigation is the enemy of good drafting. And the default rules might produce an unintended outcome, especially if you're not aware of the default rules. So it's very important when you counsel clients to have a comprehensive operating agreement that covers all of these things. It simply provides an opportunity to get everything figured out in advance, and it's really a good exercise, like drafting a partnership agreement is too. A small company, especially a single member one, could have a 2 to 3 page operating agreement. But once we have complexity, we might be looking at something that's 30 to 60 pages. So that's it for LLC formation. We have the very technical aspect of filing a very simple form. That would create the company. But if you do it without an operating agreement, you have all kinds of liabilities and risks that are a terrible headache. So technically, as a formation matter, you should also have an operating agreement which defines the LLC's governance. We've contrasted in this episode how LLC capital contributions differ from corporate share instances, and we underscored the risk of incomplete or oral agreements. Next time in episode 3, we'll tackle the question of member versus manager-managed LLCs. We'll discover how default member-managed rules can spark conflicts if the LLC isn't prepared, and why many companies opt for a manager-managed model that works like a corporation. Join me in the next episode to ensure your advice helps an LLC run smoothly and avoid internal chaos. And until then, this is Professor Seth Oranburg, and this is Mastering LLCs. Thanks for listening.